Looking for a great deal on a great business? Like the idea of getting a market-smashing 6.6% yield? Want to buy a stock that's still priced below where it was before the pandemic hit? Then you have to check out today's video.
He is a best-selling author.
30-year-old Jason Fieber has a plan.
This guy retired at only 33 years old.
I don't know if I know too many people that have accomplished something like that.
He's really kind of a guru when it comes to passive income.
Before I get into today's content, please give us a big thumbs up if you find value in our videos. Helps us to get the word out and grow the channel, and I'd really appreciate it. And make sure to stay tuned until the end of the video for a special news announcement. I want to tell you about a high quality stock that pays big, growing, reliable dividends. These growing dividends are funded by growing profit because this business is serving a critical role in North America's energy complex. Many people are excited for a green energy future, but in the meantime, we still need hydrocarbons. That's reality. Just ask Europe what happens when you try to move too fast into renewables that aren't ready yet. The good news about this company is that it's exposed to both traditional energy and future energy projects, and that bodes well for its ability to continue growing its profit and paying out its big growing dividend. I've personally invested in stocks just like this one on my way to going from below broke at age 27 to financially free at 33. By the way, I explain exactly how I achieved financial freedom in just 6 years in my early retirement blueprint. If you're interested, you can download a free copy of my early retirement blueprint using the link in the description of this video. Getting back to the stock I'll tell you about today though, perhaps best of all, it looks undervalued right now. Price is what you pay, but value is what you get. Why is that important? Because buying a dividend growth stock when it's undervalued should provide for a higher yield, greater long-term total return potential, and reduced risk. With this in mind, I want to share with you an opportunity I recently came across in shares of Enbridge Inc., which appear to be trading at a significant discount today. Enbridge Inc., stock ticker ENB, is an energy distribution and transportation company that owns and operates crude and natural gas pipelines across the United States and Canada. It also operates a gas utility business. Additionally, the company has considerable exposure to renewable energy through a diversified portfolio of renewable energy projects. Founded in 1949, Enbridge is now an $83 billion by market cap energy juggernaut that employs more than 11,000 people. The company has 5 business segments: energy services, 47% of fiscal year 2020 revenue, liquids pipelines, 27%, gas transmission and midstream, 13%, gas distribution, 12%, and renewable power distribution, 2%. By merging with Spectra Energy Corp in 2017, Enbridge became the largest energy infrastructure company in North America. Enbridge operates the world's longest and most complex crude oil and liquids transportation system. To give you some perspective on that system, their pipeline network stretches from Norman Wells, Canada to Brownsville, Texas. They operate over 17,000 miles of active crude pipeline across North America, split nearly evenly between the US and Canada. The company transports 25% of the crude oil produced in North America, and they also transport 20% of all natural gas consumed in the US. Simply put, this company owns and manages vital energy infrastructure. In addition to this energy infrastructure, Enbridge is Canada's largest natural gas utility. The company serves approximately 3.8 million retail customers in Ontario and Quebec. Not content to rest on their laurels though, Enbridge is working hard to cement their place in the future of energy. Enbridge cleverly calls this, quote-unquote, bridge to the energy future. The company is aiming to have net zero emissions by 2050. Toward that end, Enbridge has committed almost $8 billion to renewable energy and power transmission projects that are currently in operation or under construction. This category includes significant onshore and offshore wind developments in North America and Europe. Some of their low-carbon opportunities include renewable natural gas, hydrogen power to gas, and carbon capture. Now, the world is trying to wean itself off of hydrocarbons, but the uncomfortable truth is that our modern-day society currently cannot function without these traditional energy products. Recent energy shortages throughout Europe are a glimpse into what can happen if you ignore reality and try to meet current power demands with insufficient future energy supplies. Circling back around to the core business model, Enbridge has impressively insulated itself from volatile commodity pricing. The company estimates that approximately 98% of its cash flow is predictable through regulated operations, take-or-pay contracts, or fixed fees. With the business deftly balancing current power needs with future energy preparedness, they're positioned to continue pipelining increasing dividends straight to their shareholders. The company has increased its dividend for 25 consecutive years, a great look made even greater by the 10-year dividend growth rate of 11.3%. I always love to see a double-digit long-term dividend growth rate, but I especially love it when the yield is this high. The stock yields 6.6%. That's 5 times higher than the broader market's yield. It's also 90 basis points higher than the stock's own 5-year average yield. You will almost never see a yield this high paired with a growth rate this high, and the dividend is secured by a payout ratio of 68.9% based on midpoint guidance for this fiscal year's DCF per share. These dividend metrics are out of this world. Looking at business growth, Enbridge has increased its revenue from Canadian $19.4 billion in fiscal year 2011 to Canadian $39.1 billion in fiscal year 2020. That's a compound annual growth rate of 8.1%. Great revenue growth. However, it's important to keep in mind that much of the top line growth was fueled by Enbridge's 2017 acquisition of Spectra Energy. I usually show 10 years worth of top line and bottom line growth in my analyses. That's a fairly long period of time, which tends to smooth out short-term fluctuations and provide a long-term lens through which to look at a business. But since the Spectra Energy acquisition fundamentally changed the business, I'll be showing bottom line growth from fiscal year 2017 onward. Being an infrastructure business with a large midstream presence, it translates its profits like an MLP would as distributable cash flow per share instead of earnings per share like a normal corporation. So that's what we'll look at. Enbridge's DCF per share grew from Canadian $3.68 in fiscal year 2017 to Canadian $4.67 in fiscal year 2020, which is a compound annual growth rate of 8.3%. This is a very strong result, and that's even after factoring in the turmoil that the pandemic brought to energy markets during 2020. I think this shows how resilient the business model is, which speaks on the point I made earlier regarding predictable cash flow. Looking forward, CFRA is forecasting that Enbridge will compound its earnings per share at an annual rate of 15% over the next 3 years. I believe that's CFRA's way of looking at cash flow growth. This would mark a significant acceleration in Enbridge's growth. Now, I'm not sure I see a convincing case for Enbridge to nearly double its bottom line growth rate over the next few years. On the other hand, I see no reason why one would expect any kind of material slowdown in growth. For further perspective, Enbridge itself is guiding for Canadian $5 in DCF per share at the high end for fiscal year 2021, and that would represent 7.1% year-over-year growth if they hit that number. I expect Enbridge, due to its consistent and predictable cash flow, to continue with the status quo as it relates to its bottom line growth. And that should translate to like dividend growth. When combining high single-digit dividend growth with a starting yield of 6.6%, that's more than enough to make this a compelling long-term idea. Moving over to the balance sheet, the company is in good financial position. The long-term debt-to-equity ratio is 1.0. Notably, Enbridge has lowered its consolidated debt-to-EBITDA ratio from approximately 6 in 2016 to now 4.6. Their credit ratings are in investment-grade territory. Standard & Poor's rates their senior unsecured debt at BBB+, Moody's Baa2, Fitch BBB+. Furthermore, Enbridge states that 95% of its own customers are investment grade. Profitability is difficult to gauge. That's because of the way profit is translated. GAAP numbers can be misleading or even downright meaningless. With that said, over the last 5 years, the firm has averaged annual net margin of 7.4% and annual return on equity of 6.8%. Within the energy space, this is one of my favorite long-term investments. It has the kind of operational resiliency and dividend reliability that I love to see. And the company does have durable competitive advantages that include massive scale and extremely high barriers to entry. Simply put, it would be almost impossible to build a competing pipeline network from scratch today. Of course, there are risks to consider. Regulation, litigation, and competition are omnipresent risks in every industry. While Enbridge doesn't have many direct competitors, regulation and litigation are big risks in their industry. Their current dispute with Michigan over their Line 5 is a prime example of that. Regulation can sometimes work to their advantage, though. It's becoming increasingly difficult for companies to get permits to build new pipelines, making the existing infrastructure that much more valuable. While scale is a key advantage, it also works against them in some ways. There's less growth potential with a mature, scaled-up business like this. Even though the company is largely insulated from volatile commodity pricing, they remain sensitive to energy over the long run through demand and counterparty risk. There's long-term risk in the very business model, with society starting to move away from hydrocarbons. Enbridge has invested in renewables, but the core business model remains based around hydrocarbons. It is possible, though, that the network could be repurposed in the future for the storage and transportation of hydrogen as the energy transition plays out. Their balance sheet is good and better than it used to be, but it remains encumbered. Any increase in costs as it relates to raising capital via equity or debt would harm the company's growth plans. Overall, I see Enbridge as a prime candidate for long-term dividend growth investors looking for yield at the expense of higher risk. With the stock still priced below its pre-pandemic high, the valuation makes this idea even more appealing right now. The stock is trading hands for a forward price to DCF ratio of 8.3 based on midpoint guidance for this fiscal year. With that being roughly analogous to a price earnings ratio on a normal stock, it's obscenely cheap when compared to almost anything else out there. However, this is a stock that's always cheap. I think the market has considered the risks and decided to approach this name prudently, and that's fair. The 5-year average price to cash flow ratio for the stock is only 9.4, which is very low, and the current price to cash flow ratio of 11.1, also very low, is actually running ahead of that average, but the yield, as noted earlier, is substantially higher than its own recent historical average. I valued shares using a dividend discount model analysis. I factored in an 8% discount rate to account for the high yield and a long-term dividend growth rate of 3%. This looks ultra conservative when you compare that to the long-term demonstrated dividend growth rate, the long-term DCF per share growth, and the near-term forecast for bottom line growth. Well, it looks ultra conservative because it is. I think it's wise to be careful with the expectations here, and one has to respect the risks. Keep in mind, the most recent dividend increase announced last December was only 3.1%, and the company's own midpoint guidance for this fiscal year would put year-over-year DCF per share growth at 3.9%. I'd rather err on the side of caution, although I acknowledge there could be a lot of possible upside here as it relates to future dividend increases. The dividend discount model analysis gives me a fair value of $55.21. The reason I use a dividend discount model analysis is because a business is ultimately equal to the sum of all the future cash flow it can provide. The dividend discount model analysis is a tailored version of the discounted cash flow model analysis, as it simply substitutes dividends and dividend growth for cash flow and growth. It then discounts those future dividends back to the present day to account for the time value money, since $1 tomorrow is not worth the same amount as $1 today. I find it to be a fairly accurate way to value dividend growth stocks. Morningstar rates Enbridge as a 3-star stock with a fair value estimate of $44. CFRA rates Enbridge as a 3-star hold with a 12-month target price of $44. I came out high, which surprises me. Averaging the three numbers out gives us a final valuation of $47.74, which would indicate the stock is possibly 18% undervalued. Here's the bottom line, guys. Enbridge Inc. is the largest energy infrastructure company in North America. Its operational resiliency and dividend reliability are rare in this industry. With a 6.6% yield, 25 consecutive years of dividend increases, a reasonable payout ratio, double-digit long-term dividend growth, and the potential that shares are 18% undervalued, this is a compelling long-term idea for yield-seeking dividend growth investors. And now for a special news announcement. Lowe's Companies Inc., stock ticker LOW, just announced Q3 results that blew expectations away, easily beating on both the top line and bottom line. Even with very tough year-over-year comps, they still managed to exceed their marks. I featured this stock as one of my weekly undervalued picks back in mid-August. It's gone on a big run, but there's likely much more to come.
Thanks so much for watching. I hope you enjoyed today's video. Give us a like if you did, and let us know in the comments what you think about this stock. Please make sure to subscribe to the channel and ring that notification bell so you don't miss out on new content. Also take a look at the description box below for some important links, including the link to my personal stock portfolio. This 6-figure portfolio, which I call the Fire Fund, generates enough passive dividend income for me to live off of. It allowed me to retire in my early 30s. I've made my portfolio entirely accessible over a Patreon, and I also post alerts there whenever I buy or sell a stock. I put my money where my mouth is, and I'm often invested in the same high-quality dividend growth stocks that I make videos on. Over the years, I've heard from thousands of investors who have been profiting from many of the same exact stocks that I own. So if you think this is something that you could benefit from as well, check the link in the description to see my portfolio and start getting my buy and sell alerts. I'll see you next time.